We have a paper that's not about high-frequency trading. One of the, I think this fits very well in discussions with financial regulation because, of course, one of the main reasons for regulating any market is market failure. And the famous 3Com Palm example is often cited as a case where markets failed spectacularly. And I think that this paper very nicely raises a lot of doubts about that. Anyway, here's Chester Spatt, who will talk about Palm 3Com.
Thanks, Paul. I'm delighted to have the opportunity to present the paper here this morning. And as Paul highlighted in his introduction, the paper, I think, will shed some light upon how the markets were functioning during this classic, what's been viewed by some as mispricing between Palm and 3Com. And I think it actually shed a lot of light on that. In a way, our paper is about, some critics of the paper might say our paper is about, well, it's just about limits to arbitrage, and that there are limits to arbitrage. But I think that from another perspective, what our paper does is it quantifies and provides market evidence as to the magnitude of the nature of those, of that, from the point of view of looking at lending markets. And because of the way in which we look at lending markets, I would also say that this is a paper about market failure, on the one hand about market failure, but on the other hand, basically about market microstructure. It is a paper, I think, about market microstructure, and I think of it as fitting very well in a market microstructure-oriented conference like the fair extent this one, because lending markets are at the heart of the microstructure of the way in which our the underpinnings of how our markets work. So, many of the younger members of the audience may not remember this, but there was this interesting phenomenon viewed by many as an arbitrage in the year 2000. And this arbitrage got a lot of attention. It got so much attention that it was written up by various writers of the Wall Street Journal, various writers of the New York Times. But despite that, it seemed to continue. And I think this was viewed as perhaps even more evidence that markets didn't know how to do arithmetic. In the words of the important paper that really put a spotlight on this. But I want to offer a quite different perspective. So, at the time, Palm was a wholly owned subsidiary of 3Com. And Palm had a very interesting little device. It's called a personal digital assistant. And it had things like a calendar and some other things. And did a small set of the things that our smartphones do these days. But Palm's product took the world by storm. And folks thought that Palm might be very, very valuable. Kind of like how the iPhone and Apple became very, very valuable more than a decade later. And Palm was basically owned by 3Com. That was in a rather different part of the tech space. And then the 3Com kind of decided it wasn't doing a good job of managing this and needed to kind of have its own, the Palm could be best managed centrally, so it decided to move along the path to spin it off. It initially IPO'd 5% of Palm. The rest was going to be spun off at the end of the year 2000, and at a rate of 1.5 Palm shares for every 3Com share. So but the IPO occurred on March 2nd, and by the end of the first day of trading, the market value of the Palm shares, once you extrapolate it, of course only 5% of it was put into the market. And once you scale up the other 95%, the Palm shares were worth $54 billion. And 3Com, remember, owned 95% of that, in addition to what was out there in the marketplace. But 3Com's market value was then only $28 billion. But of course, 3Com, $50 billion in Palm shares. So if you value the rest of Palm, 3Com's business by following the standard type of calculation. 28 minus 50 is minus 22. And so some thought, well, how could the rest of the business be worth so little? Indeed, the classic paper by Lamont and Thaler says, and I think referring to this translation ratio of 1.5, says we don't need to agree on a model of asset pricing to agree on the proposition that one share of 3 comps should be worth at least 1.5 shares of POM. Well, we actually disagree with that, and we'll have empirical evidence consistent with this disagreement, but we'll also highlight more. Well, let me say this now. So the POM shares can be loaned directly, but if you own 3 COM shares, at least until the point of the completion of the spinoff, if you own the 3 COM shares, you're not in a position to loan out the POM, even though you have this claim to the POM. So think of what you own as 3 COM, as a 3 COM stockholder, as a forward contract on POM. You don't actually own the POM as of today, but you own a forward contract on it. But to the extent that there are interim dividends, or I think of this in terms of commodities parlance, to the extent that there's some possibility of a stock out or a scarcity, a lot of scarcity value in the interim, you don't have, if you're a 3 COM stockholder, you don't have any way to capture that. And I think that perspective will be at the heart of a lot of the insights that we describe. So the negative stub value was viewed as an apparent arbitrage opportunity, and it seemed to persist for months. And here's using the usual type of calculation of the stub value along the lines I just described. Here's a calculation of the stub value from the IPO date, of course, forward in dollars per share. And this leads to some inevitable questions. Can we rely on market value? Is the no arbitrage assumption about financial markets valid? Now, a couple of key dates to keep in mind. So the IPO happens on March 2nd. On March 16th, traded options on POM start to be operated. That'll be very helpful for our empirical analysis. Then it was anticipated that this spinoff was going to be completed at the end of the year, in December. But it does turn out that on May 8th, there's a very interesting announcement from the IRS. The IRS approves the completion of the spinoff on a tax-free basis, and that's a crucial issue in many of these situations. And POM announces that it will complete this transaction as of the end of July, as of July 27th, and I'll have more to say about that shortly. But you can see at that point, then the stub value no longer looks to be negative. So Lamont and Thaler in their paper, they raise a variety of concerns about whether markets know how to do arithmetic. For example, on May 9th, so the IRS announcement and POMS-related announcement, these occurred after the close on May 8th. So the relevant price changes on a daily basis would have occurred on May 9th. On this crucial date, May 9th, POM's price went down 10%, and 3 COM's price went up 10%. For those who think that these things should be moving exactly together or in a ratio of 1.5, yet more evidence that markets don't know how to do arithmetic. Another factoid that's pointed to is that 3 COM closed on March 1st at 104, basically closed it on March 2nd at 82. How can we understand this 21% decline? This seems to me related, this was right at the point of the IPO, this seems to be related to the general problem associated with IPOs, that there's a lot of resolution of uncertainty. And in this case, there was a lot of resolution of uncertainty about the POM value. And Lamont and Thaler point to these violations of first principles and arbitrage principles in a variety of ways. And the fact that there's a lot of different ways to do so, the way I think about that is if you tell me that 2 equals 3, I can then transform that into lots of different ways of defining mispricing or defining other statements that are false. So the fact that there's 5 different ways of defining a false statement, that's kind of equivalent to kind of that there's one different way. But that's fine, because there's different lenses, because we'll in fact bring different lenses to the problem to inform these issues. So for example, Taylor highlighted a violation of put call parity. For example, that the at-the-money November options, the call is about $11 and the put's about $22. And that seems to be odd. Usually we think of call prices as being substantially greater than put prices. But that would not. But there's an important exception to that. If a stock is paying substantial dividends, in fact, we might expect that the call price would be substantially below the put price, as opposed to the other way around. In this case, of course, Palm wasn't paying directly substantial dividends, but there was this thing called these lending fees, and the lending fees were very big. I'll have more to say about that. The lending fees were very, very big. They were on the order of 30 to 50%. So that's like a dividend, but it's a huge dividend. It's not like your plain vanilla 2% dividend. So broadly, my plan is going to be to try to explain the Palm and 3Com price behavior, to show that the arbitrage trade involved was risky and costly, to show you also that the stub value was positive, and that the relative price movements were such that a dollar movement in Palm should add a lot less than $1.50 to 3Com, and at the same time that the market seemed to correctly understand the nature of the structure of lending fees. My interpretation is that the Palm 3Com price relationship was not erratic. The prices here of the synthetics reflected the cost of shorting Palm. That when you adjust these relationships in the appropriate way, that there really weren't violations of put call parity, the lower one price. That there was in fact an important regime shift on May 9th, which kind of explained why one asset went like this and the other asset went like this. And a point that I'm not going to emphasize as much is that potentially a parent company could, that if you accept the observation that a parent company can destroy value of its subsidiaries, we could potentially provide a fully rational explanation for all the pricing. But I'm not going to go very far down that path. I want to focus really more on the lending fees and how these valuations wind up. So, Lamont Taylor suggests basically the following arbitrage trade: that since each 3Com share contains 1.5 shares of Palm, you could get payoffs based upon the Palm price at the start of this on March 2nd. You could get $143 of payoffs, but you could get that by buying the 3Com share, but about $82. So potentially a rather large arbitrage profit. But this trade, of course, among other things, just as an aside, this trade is predicated on certainty of the spinoff. But I think an important paper that it can roughly contemporaneous with the Lamont Taylor paper, where I'm showing subsequent to it, that kind of shed some light on this was the paper by Mitchell, Polvino, and Stafford, which documented that of 84 similar cases, spinoffs didn't occur in 30% of them. So an important factoid to take away from that is that while with hindsight, everybody views it as a fait accompli that Palm was spun off from 3Com, and indeed that's what happened. There's a lot of Monday morning in football parlance, sort of appropriate from this game. In football parlance, there was a lot of Monday morning quarterbacking. We know ex post, Palm was spun off. But ex ante, Mitchell, Polvino, and Stafford pointed out that in about 30% of the situations, this didn't actually happen. And indeed, spin-off uncertainty, I think, is important. In this case, there was a surprise. The surprise was actually in the opposite direction. Namely, that the spin-off happened even more quickly, I think, than many market participants expected. And to just emphasize to you from a kind of a more of a legalistic perspective about the spin-off and spin-off time being uncertain, I'll just point to you what the documents say. The prospectus says that 3Com may modify the distribution, including by accelerating or delaying the time. The distribution can be canceled if, in the sole judgment of the board of directors of 3Com, the distribution would result in a material adverse effect on 3Com or on the stockholders of 3Com. So even as the groundwork is being laid, it's not clear, it's not 100% clear that this transaction has to move forward. There is spin-off uncertainty. So shorting Palm, I also want to emphasize, was very costly. So we got a very small data set with just under 10 just under 10 observations, but covering quite a bit of shares, and in fact covering about a quarter of the shares, a quarter of the float of Palm. We got this data set from one broker. It's a data set of lending transactions from the relevant time period. It's a small number of transactions, but they're clearly of institutional size. They point to basically prices in the 20 to 60% range. Most of the observations being sort of the 30 to 50% range. These are annualized lending fees. These are obviously big numbers. These aren't like a stock 2% dividend. And in particular, the point I want to emphasize to you, if you own the 3Com, you don't have any ability to collect these fees. If you own the Palm, you might as well loan out the shares and collect the fees up to the point that you want to sell them. And indeed, I would argue, if you own the Palm and you didn't loan out the shares, you would be an irresponsible investor. Who knows, maybe in that era, the SEC should have brought cases against those who didn't loan out the shares for violating their fiduciary duty. But that's neither here nor there. So on May 8th, when the events of May 8th happened, I've already highlighted a little bit about the substantive activity on May 8th. Actually, the lending fees spiked upward, and this is associated with a decline in the perceived length of time before the Palm shares would be widely available. That is, before the rest of the spin-off occurred. So this is actual data, and I present the actual data to you in this form at this point, just to emphasize to you that this is not simply a hypothetical scenario, but market participants knew what these lending fees were. I have one slightly related experience. I have one prior paper on financial arbitrage. That was a paper long before this, in the American Economic Review, on huge mispricings between various RJR and Visco bonds. This was published in 1993 in the American Economic Review. And while we don't report it in the paper, when we made some limited forays into trying to borrow the expensive bonds, we certainly couldn't get anybody to give us interest credit, that's for sure, in an environment where interest rates were like 10%. And one well-known institutional broker, they said to us, "Oh yeah, well we can't, of course, we could loan you some shares, but we'll charge you an additional 13%." So, it's not unprecedented for lending fees to be big. Now, why does the Palm? Why does a dollar change in Palm contribute less than $1.50 change in 3Com? A couple of points to highlight. When the spin-off is uncertain and shorting is costly, the relationship between these prices becomes a lot more complex. And I'm suggesting basically this relationship is not going to be simply one for one. So what we do instead is we calibrate the relationship And for reasonable values of parameters, we suggest that it matches the empirical magnitudes. Now, let me provide you a simpler example of this. So imagine that there was a constant lending fee of 34% with a 6% risk-free return. It turns out then that the capitalized value and you compute everything out for one full year. So we go out one full calendar year. The capitalized value of the lending fees would equal 29% of Palm's price. So what that says is that Palm's intrinsic value is only 71% of the full traded value, and that's really at the core of the issue. So what this is highlighting is that when the price of Palm changes by $1, the value of 3Com should not change by $1.50. The value of 3Com should change in this example only by $1.06. You multiply the 1.5 times the 71%, which is the proportion that's the intrinsic value, because otherwise there's sort of some levering up of the underlying value. Now, obviously, as you play with the parameters, that's gonna change things a bit. So, for example, if you now move the spinoff closer, instead of it being 1 year out, but it's only 6 months out, then the capitalized value of the lending fees would be 16% of the purchase price, and the intrinsic value would be 84%. In that case, we would get a coefficient of 1.26. But notice we're getting coefficients substantially below 1.5. And as we shorten up the horizon, we increase the sensitivity. And indeed, that's what happened in the data. Now, we could generalize the example. So we could allow the possibility of there being well, we could certainly, here what we do is we just make it parametric, but the same basic point. And to kind of, to drill down a little bit more upon this relationship, these relationships, the no arbitrage relationship within Palm itself, when we think about the relationship between the spot and the forward, in the presence of lending fees, it's really given by this equation toward the top of the slide. In effect, the spot price equals the present value of the forward plus the present value of the lending fees. And that's basically, I would describe that equation as sort of commodity valuation 101. Basically, this is saying that we think about, so in commodity parlance, what I'm calling here the present value of the lending fees, that's the convenience value, right? Or I think of it in maybe slightly more modern parlance. I think of it in terms of option values associated with stock out. And if you own the forward, you have no protection. That forward doesn't help you if there's a stock out. You think it'd be nice to have the forward. Yeah, and it gives you protection, but it only gives you protection after the expiration of the forward. It doesn't help you if there was a stock out before. The spot helps you if there's a stock out before because you can use the spot, but you can't use the forward. And that's really the key economic difference, and that's at the underpinning of what convenience value is all about. Think of this representation in a similar kind of way. If you own the Palm in the spot market, you get the lending fees. If you simply have a forward, you don't get them. All that owning 3Com does is it gives you the forward on the Palm. It doesn't give you the spot. And that's really at the core of the relationship. So now you might wonder, okay, well that's all very nice that we should. So we're suggesting that we should think about this in terms of the forward price, in terms of the forward prices. Well, that's all very nice, but are we going to be able to do much with that? Where are we going to get the forward prices? And before describing how we compute the forward prices, let me just say, so I cast this so far in terms of the spot on the Palm and the forward on the Palm. But instead, I can cast it in terms of 3Com and Palm, and so if I cast it that way, notice that the stub, when I kind of write this out in terms of the stub on 3Com, the stub on 3Com it's not now the difference between 3-com and POM, but it's the difference between 3-com and the present value, and the forward on POM. So in computing the stub, it's a question of what object we're using. Now, so how do we now get the forward? Well, so I think at some point in this analysis, I thought, how are we going to get the forward? I guess we're going to have to hypothesize what the forward is. But no, we don't have to just do that. There's a market. And the market is a kind of a convenient market. It's not perfectly, it doesn't perfectly line up with what we want, but it comes pretty close. What's the relevant market? It's the one I alluded to before. It's the options markets. So the options markets are open 2 weeks later on March 16th. So starting March 16th, we've got nice option prices. And option pricing theory then gives us some nice little guidance about this. In particular, there's this basic relationship called put-call parity theorem, which basically links, I think of it intuitively as something like that the call minus the put equals the stock. That's kind of how I learned it a long time ago. Well, in this context, you'd really link it back to the forward, and the only real wrinkle. So in effect, then we're in a position to really be able to compute the forward, and the only wrinkle that I should point out to you is that, well, the traded options, they're not exactly European options, they're American options, which is sort of too bad, but I think this still gets us, I think, most of the way there. But the traded options are American options. The theory, the way in which we've invoked the theory is based upon their being as if they were European options. So what are so can we go ahead? What happens when we go ahead and compute the forward? Well, here we have some option prices, and we got them at a very convenient source. We got them directly from the Lamont Taylor paper. So Lamont Taylor, they have some interesting option prices. Good prices, S prices, ... So we tabulate the prices from there, and then we do one additional calculation, namely we compute the forwards. Notice when we compute the forwards, notice that the term structure is downward sloping. Now, some might interpret this as saying, oh, the forwards are downward sloping. There's an arbitrage in the forwards. No, there's no arbitrage in the forwards. In commodity valuation, if the risk of stock out is considerable, you'd expect to have, and let's say storage costs were not a factor, and the risk of stock out is considerable, you'd expect to have a downward sloping forward curve. That's exactly what we have here. Another way to say it is, if there's a lot of dividends, or here's directly, of course, lending fees, that's basically driving this tremendous downward slope. And the magnitudes of these differences, just do it like an order of magnitude calculation here. Look the May to the August, or the August to the November. For a quarter, we're basically talking about more than $3. Now, take that and you just do some order of magnitude calculations, annualize that. You're getting orders of magnitude that are exactly like the lending fees, like 30%. That's exactly what you sort of see right here, right off this relationship. So that's kind of the hint that maybe there's something to our story. So if you viewed the spinoff date as certain, and you just computed the stub value, but plugged in, instead of for the spot price, the forward price, we would get this picture for the stub. And so basically I accepted a couple of very specific dates. Basically the stub value isn't negative at all. And this is just by simply substituting in the forward for the spot. And I would say the first order, the forward is the right price to use, not the spot. So we do, in the paper, we do some modeling to address the issue of uncertainty, POM's contribution to 3-com under the spinoff, by viewing the timing of it as uncertain. We do a variety. We at various times in our analysis, we've We've done the empirical analysis in a variety of ways. These coefficients don't quite match what's currently in the paper, but it gives you the same, give you the same feel. When we use intraday data, for example, for March 2nd, and we use the Stockton-Watson the dynamic method, we get a coefficient of about 0.4, but that's like right at the start. And that's when things are pretty far away, when there's a lot of uncertainty when we look at this regression. But in particular, these things are moving together. The coefficient's pretty low, but it's reflecting that there's a lot of uncertainty, and that the spin-off date is far away. Oh, now here's minute-by-minute data from that first day. Now, one of the puzzles that Lamontel pointed to was that the prices on the first day, they thought those price movements were kind of odd, in part because there were some valuation changes. But let's just look at what's happening minute by minute. These assets, the two assets, the POM and the 3-com, they seem to be moving together. I mean, they're not perfectly correlated, of course, but they are moving together with a reasonable sensitivity. So let me turn back to the. So I've already highlighted this regime change that happened on May 8th, and I'll sort of lay this out now with this forward timeline. The price responses, I think, to what happened on May 8th, I think they're very consistent with what we'd expect. We're shortening up after that. The instead of expecting that the loans were going to continue to December, now we expect they're only going to continue about 2.5 months instead of for most of the rest of the year. So your loans are only going to be about a third as long. The POM is now less valuable. Why is the POM less valuable? Because you're going to be able to earn lending fees over a much smaller period of time. Yet 3-com is more valuable. Why is it more valuable? Because because it's now clear that this deal is going to happen. The deal uncertainty has gone away. And so as a 3-com stockholder, you're going to be able to unleash the value of POM and not miss too much lending fees. So I think these price changes make sense. And we did a whole variety of different types of statistical analyses. When I say a whole variety, to some extent, we did different analyses in different updates to the paper. Let me just point to you on 2 different dates, but dates that are discretely different, May 8th and May 9th, right, so right at the time of this regime change. So basically, the sensitivity coefficient increases substantially, and increases basically to pretty close to 1.5 after this uncertainty is resolved. In fact, maybe even a little bit too close to 1.5 in some sense. But the basic point is that the sensitivity coefficient moves in the way that we expect, and in fact, we would expect the sensitivity coefficient should be very different in the before and after regime. The forward, as I've already noted, of course, the forward prices were reflecting the lending fees, and analogously in commodity valuation, the forward price doesn't reflect its value, doesn't reflect its use value prior to the expiration of the forward. There's another aspect of commodity valuation I should take a moment to comment upon. So one of the criticisms of our paper is, well, we haven't. I think one of the criticisms of our paper is that we have not explained how come the lending fees are basically above zero. That we have simply not explained that, and that's true. We have not explained that. But what I want to argue is that one shouldn't sort of narrowly think about the nature of what equilibrium is here as just involving the spot on POM and the spot on 3-com, and viewing the lending fees as off here. I would take a different view. There's 3 prices. There's the spot, I'm sorry, there's the POM, there's the 3-com, and the lending fee on POM. And the restriction of equilibrium is that those 3 prices are consistent with each other. And let me suggest to you an analogy in commodities. So there's a lot of discussion, many of you have probably read, about oil prices recently. You've obviously read that they've kind of gone down a lot, but you may have also read that the spot and the forward are kind of out of whack. And there's a lot of demand for storage. And the storage values are way up. Now, so there's the fact that storage, and the folks who control storage are presumably not necessarily so anxious to share that. They presumably want to collect that. They don't necessarily want to share that with the others. So it's really a three-price, again, I would argue it's a three-price system. There's in oil and other commodities, there's the spot, there's the forward, there's the storage. And if the way the storage manifests itself is through ships on, so one of the ways they store oil is they store oil with ships on the sea. Consider the following hypothetical. Suppose the shipping industry was controlled by a small number, hypothetically, of Greek shipping magnates. And the Greek shipping magnates, they all had breakfast together, and they decided they're going to act collusively. Well, you would expect that those folks, they might be able to extract a lot of the differential value. Now, I'm not saying that the short sellers here were acting collusively, but the point is the industrial organization of how the stock is distributed, just like the industrial organization of how storage is distributed, is going to affect the equilibrium balance across the 3 assets. So I think this commodity analogy is potentially a pretty apt one. Now, another way to drill down is to look at implied volatilities. Now, when we did that with calls and puts, just using the spot price, the spot prices, and without considering the lending fees, we get very different implied volatilities on the calls and on the puts, suggesting that pricing is out of whack. Well, once we adjust for the lending fees, basically the implied volatilities on the call, through the call side and the put side, they're the same. So another way to sort of summarize some of that, option prices were reflecting the lending fees. The option price does reflect, in effect, this dividend prior to expiration. And when lending fees are properly considered, there are put call parity violations, there are violations of the law of one price, there is a negative stub value. So let me link now. I presented to you before really the red curve. That was the actual lending fees. So now I want to link it up based upon our limited data. And as I said, it was about 10 transactions, pretty modest set of transactions. So let me now link it up to the implied lending fees. The way we get implied lending fees is off of these option prices. And what you see is, at least order of magnitude wise, these markets seem to be kind of connected, and they seem to be They seem to at least be giving you the same order of magnitude. So one way to get it is through the actual data. Another is just to use the theory, and I think the theory, and I think we were pushing forward with this paper even before we got the actual data that we got when we already felt that we had a coherent and good argument, and that was based in part upon computing the implied lending fees. So let me turn then to another aspect of the implied lending fee, which is, what about the implied lending fee between August and November, before and after May 8th? So remember, before May 8th, folks thought that this was, okay, good. Before May 8th, folks thought that this was going to continue. These high lending fees were going to continue till about December. And after May 8th, it became clear that wasn't going to happen, that this was going to end by the end of July. So the question is, so what happened to the implied lend? Now, meanwhile, there were traded options that were maturing in August and traded options that were maturing in November. So the November ones, they're pretty close to the December. The August ones, they're at least after the end of July. But presumably before, there would have been a lot of action, a lot of value in the implied lending rates in the August to November period, and maybe not so much value once this uncertainty is resolved. Indeed, the May 8th announcement basically drove the August to November implied lending fee down from about 25% to 0. And let me show you that more specifically. So here's a plot of the evolution of the August to November implied lending fee. So it's sort of backing out the implied lending fee over the subsequent interval. And notice that it's sort of basically, these numbers are basically like a roughly 30% or so. And then comes May 8th. And so let me unmask the cover. Basically, the implied lending fees from August to November, they basically dropped to 0. And what does this say? The market learned something important on May 8th. So in fact, this certainly documents our little story that there was a lot of resolution of uncertainty. Basically, the uncertainty is all resolved. You can see some, but notice in particular that the market does know how to do arithmetic. It nailed, and I don't know that they brought these tools to bear, but it nailed the appropriate lending fee in this sort of August to November time period. I think the little story about non-lending investors and who buys Palm directly before may not. Let me put that aside. I think we'll just skip that. So we turn to the overall conclusions. So I think, given short sale constraints, it's clear to us that markets actually work pretty well, and they were in equilibrium. Now, I don't want to say that the markets were working perfectly. Obviously, there were some aspects of this period that were somewhat dysfunctional. And certainly, we're not suggesting that we have an explanation for the internet bubble or why valuation was high. That's not the point. I think the point is to recognize that financial markets are sort of more sophisticated than I think sometimes we think. These markets are really pretty sophisticated. And I think this perspective of looking at the lending fees, I think helps drill down on that. The Palm and the 3Com prices gave sensible forecasts that they expected spin-off date. The co-movements of Palm and 3Com were pretty sensible. And it looked like that those were puzzling a priori, but I think if we think about it a little bit more carefully, I think they were pretty sensible. The market seemed to have the correct response, not a crazy response, but the correct response to the May 8th news. A little bit more difficult to support the direct purchase of Palm by non-lenders. In the paper, we have a little story along those lines too. I think that's probably a little less compelling than maybe some of the other aspects of our analysis. But anyway, so let me stop it, since I hit the 5-minute mark a couple of minutes ago. Let me stop it at this point and look forward to the discussions and your feedback on this.
The first discussant is Jennifer Marietta Westburg from the Institute.
All right, well, thank you for inviting me to discuss this paper. I very much enjoyed reading it, and I encourage all of you to take a look. It was very interesting to see someone provide a solution to a puzzle that had been out there for years, and I think that Chester did an excellent job of walking you through the reasoning that seems very straightforward, of course, once you see it. So that undersells the paper, the fact that this puzzle had been out in the literature for years. I will quickly go through the standard disclaimer and then on to my questions. So through Chester's presentation here again today, I think he did a great job of discussing his work. And I really only have a few questions here. I'll go through my questions and then I want to talk about another potential market failure, or at least those that think there may be a market failure related to securities lending, and a data initiative that we have through some governmental pilot programs. And so as academics, you may be interested in that. The basic findings here, very quickly, offers an alternative to the Palm 3Com pricing puzzle. And the share values between the two, as posited in the paper, will differ based on the capitalized value of the lending fees and the uncertainty about the spinoff. Once Chester has gone through his results, the violations of put-call parity and the law of one price disappear. Again, I think it's very effective. So the few open questions that I have, Paul started out by talking that he was interested in this paper because from a regulatory view, we often see papers that say there is a market failure. Here you have a situation where someone has solved the market failure, at least put out a potential reason that the market failure is solved here. So I thought there could be a little bit more discussion of the Lamont and Thaler paper and some of the related literature in this particular paper, whether they had posited alternative hypotheses. I think the answer is yes, the market failure has been solved after you read this paper, but I'm curious whether Chester thinks there's a need for regulation, given that the puzzle lasted for years. Why did the puzzle last? I'm curious how Chester came upon this particular idea. So as recognized in the paper, Lamont, Thaler, and others have documented more carve-outs in which the parent value is less than the subsidiary value. So I was also curious about why the micro-focus on Palm and 3Com in this particular paper. Clearly it's one of the most egregious examples, but there were others. And I'd be curious whether this could be expanded and look at data to see whether data from other situations also match this model the way that Palm and 3Com do. Chester didn't talk a lot about the final part of his paper that talks about people that don't lend. Not all market participants can lend their shares. Now you might ask, if you can't lend, why you would buy it to begin with, given Chester's findings, but how would this impact the model? I'm curious about that. I have questions about the lending data set, and I understand that data can be hard to come by in this particular space, and that's one of the reasons I want to talk about a data initiative. So as Chester acknowledged, the large agency broker covers about 23% of the float of what was available for Palm. And so I just wanted to know more. Is there any reason that the lending rates may have varied significantly across other brokers? I know there are some data sets that at an aggregate level provide you insights into securities lending for securities. And so some of this information at the aggregate level, I know they bring it in at the transaction level, and then they'll put together information about the number of shares on loan, the average time period for the loan, some mins and maxes. So it just would be nice to see this particular broker's data sample, where it fits into the distribution, if they have access to that. Chester and his co-authors are very careful in footnote 6 to point you to some of the literature from this time period that tries to put sizes around lending rates. And so I think that's helpful, but I would like to see something more specific to Palm and 3Com. I also think that the data sample information should be moved from where it is in the appendix right now actually into the body of the paper. It's an important part of the paper, with a little bit more discussion on the sample. So these are my overarching questions as I went through the paper, and again, I found it very, very interesting, and I encourage you to read it. I want to talk a little bit more about securities lending in general and a governmental initiative that we have, potentially related, to, as I said, to others who think there may be a market failure. So there's a US pilot program to collect data around securities lending and repo. The goal is to provide greater visibility into the financial stability context. And as academics, the reason this may be relevant to you is that FSOC actually put out a request for comment in January 2015, so just this year, around the asset management industry and activities related to asset management, one of them being securities lending. So you may or may not have followed this debate in the press. Mark referenced it in his remarks yesterday. The idea, this quote here, is to understand whether and how certain asset management products and activities could pose potential risks to U.S. financial stability. And as you look through this request for comment, they focus on 4 activities: liquidity, leverage, operational risk, and resolution. How do you resolve a failing asset manager? Under the leverage section are several questions related to securities lending. So if you have thoughts about this market, that it's opaque, we don't understand it, there's not data available, you have the ability to either send in your papers or comment letters through this process. So just to tell you a little bit about the details of a related initiative to actually collect more information on transactions in this space. There is an initiative that's led by the OFR, the Fed, and the SEC. It's a voluntary pilot with less than 9 potential participants identified. The reason it's less than 9, if you're familiar with government work, is that you run into something called the Paperwork Reduction Act. If you try to survey more than 9 firms and collect information, we know this well through our work at the SEC. And if you want to go to collect information from more than 9 firms, you have to go through an elaborate process with OMB. We did this with our SOX survey. Kathleen and I worked on this together. To get approval from OMB, design the survey, launch the survey took a year. That's before any analysis started at all. So if you go to less than 9 firms, you don't run into that. And so the outreach is actually beginning right now, and there's a coincident initiative to collect information on repo data, particularly the bilateral market, because we don't have as much information there. So I thought about this in reading Chester's paper because of the difficulty in trying to find information on securities lending. Here are some of the data items that may be collected. And so those would be at the trade level. I think this is a lot of important information. The type of collateral, the transaction term. At the settlement level, whether it's cash or securities. You can see some of the information here, the rebate rate, the haircut, the securities level, the securities collateral, what's the security around it, so who has access to the collateral, the lending rate, and the haircut. Now, unfortunately, I don't think that the data that's collected here will be available to academics for research, so that's a pity. But I do think that collectively, through this initiative, we have an opportunity to learn a lot more about this market than we potentially know now, so stay tuned for that. And I just, again, if you have thoughts about the importance of securities lending, whether there is a market failure there, I encourage you to send in your comments to FSOC. Thank you. Great.
Craig Lewis is our next discussant. Craig is from Vanderbilt.
So let me reiterate by thanking you for giving me an opportunity to discuss Chester's paper. It's an interesting job as a discussant, right? There's a couple different kinds of papers that you get as a discussant, and a couple of them are your worst nightmares. One is a paper that is so bad that you don't know where to start in because there's so many things you could say about it. The other kind of paper is one that's fully developed, makes a convincing case, is clearly written, and doesn't really leave a whole lot left to do further work on. I think Chester's paper falls into the latter category. I think he makes a very convincing case for why the so-called anomalous sort of pricing of 3Com can be solved by simply looking at the pricing and bringing in some ideas about looking at forwards. So I'm fully convinced when I read the paper. I actually looked at an earlier version of the paper which relied on implied lending rates and thought the biggest hole there was the fact that there was no actual data to support. It was more of a possibility result. If the lending rates were at a certain level, you could explain the puzzle. Well, in the revision, they went out and they actually were able to obtain lending rates and sort of show that the implied estimates were in the same ballpark as the actual lending rates. So that derailed probably what I would have thought was my biggest possible contribution to the paper, and so they did that. But so what are my overall comments? It's if you've looked at the paper, you will see that it's not written like a typical paper. It's very clearly written, very well done. But it's a little short on detail, I felt. Right? If I were to speculate, I think it's written for a journal like the Journal of Economic Perspectives. Right? Doesn't have a lot of tables. So when I see a paper that has a fair amount of empirical research, I'd like to see some summary statistics. I'd like to see some summary tables. And I just felt like you don't see the normal level of detail being discussed in the paper. So if it's not being pitched for something like the Journal of Economic Perspectives, I'd like to see just a little more in the way of actual summary data so that I can evaluate what's going on. Having said that, though, that's, in my view, a minor quibble, right, with what's going on. I do think that there are some things that now that you actually have data, I would like to see you think about some ideas around what is the reasonableness of the Stub implied stub equity prices that you're coming up with. Can you say anything about that? The stub equity prices are calculated using implied lending rates. Well, we now have actual lending rates. So why not go back and price the stub equity using the actual rates and see what those prices look like, since you now have the data? The other thing I thought is have a time series of stub prices. Another way of calibrating and trying to ask how reasonable are those stub equity prices would be to effectively do a couple things. One would be to calculate the volatility of the stub prices on a daily basis and compare that to the post-spin-off volatility of Palm as a standalone company. And sort of think about those ratios. There's almost an F test there, right? Some type of null that if the pricing of the stub equity is reasonable, the volatility of that stub equity should correspond to the volatility of Palm trading as a standalone company. So there's a way of actually asking indirectly, is that stub price sort of in the ballpark? The other thing that wasn't clear, although from the paper, was whether you used American options. You did, I found out from the presentation, and you talk about violations of why put-call parity might not hold in the paper, but I wasn't clear that that's what you had, whether it was actually traded on the SIBO or whether it was an over-the-counter product and you're actually looking at European options directly. So my suggestion would be you are biasing, by using American puts, you're biasing your estimates of the stub price downward. So I would recommend just simply taking the implied vol calculations that you're making and put those back into a European option pricing model and recalculate the value of the stub price using the European call price that you can infer from the implied vol rather than using the American option. I think these are big deals. They're not going to change the overall tenor or the conclusions you draw, but I do think that they're things that are reasonable to think about in this context. You talked about fiduciary obligations. As you're going through your presentation, Chester, I thought, if anybody has a fiduciary obligation, it's the management of 3Com. And I wondered if the acceleration of the spin-off date was a recognition that at some level they could be viewed as violating their fiduciary obligation to shareholders by allowing that discrepancy to exist for so long a period of time, because all you really needed to do was spin the thing off earlier and align the pricing. And so by shortening the window over which these lending fees could be earned, you would, right, as you show, you'd get more convergence to the true price of Palm. And in that sense, any shareholder that had to sell their 3Com shares over that window was essentially selling at a price that was lower than it actually could have been had they done the spinoff earlier. So that is just a small aside. Where I think it's interesting, and where one of the real takeaways I had from the paper is this idea of looking at the value of a firm that's about to have a spinoff, and you can decompose it into the lending fee piece as well as the intrinsic fundamental value of the underlying company. And where I thought this could actually be extended in potentially very interesting way is when you think about what's going on here. What you're doing with the spinoff is you're increasing the public float, right? You're taking a firm that had 5% public float. When you have a spinoff, all of a sudden you have a massive increase in the public float. The idea then is that the supply of shares that you can lend are much greater, so you would expect the lending fees to go down. Well, if I can think of similar situations where this actually might be very interesting, and one would be around IPOs. If you think about an IPO, these are firms that have very small levels of float, but there's a lockup period. Once the lockup period is over, you have a situation where now a lot more public float can come on the market because you've essentially freed up a large number of shares so that managers and other insiders can potentially sell in the market. We know there's a negative stock price reaction on the date that the lockup period expires, and there have been a number of papers that have tried to explain why that negative stock price reaction occurs. This could simply be an alternative explanation for that, and it would be interesting to see how much of that stock price drop on the lockup date is actually attributable to the lending fee argument. So I think that could be a potentially interesting way to go. And you've thought about taking that the next step. There's still a lot of uncertainty about the level of float in an IPO, particularly a popular IPO. There's a lot of firms that follow unseasoned equity offers, which is another way of increasing the float. So you can think about the idea of float increasing as a way of explaining some of these pricing anomalies, or some of these, not anomalies, but just sort of standard reactions that we see to common corporate events. So that's all I had. I'd enjoyed the paper. It's an easy read. If you haven't looked at it, I'd encourage you to take a look at it. It's well done.
Chester, any comments?
No, both discussions were incredibly gracious, so I probably, any reply would be beside the point.
Andrew?
Actually, I have several points. The first point is, I understand why you should focus on the three-common palm example because it's a poster child of all negative steps, but I would be interested to look at some other examples, in particular method stratus lighting example, which is
I'm sorry?
the Mitchell Pulvina Stafford statement. There is another example which is very interesting, method stratus lighting, where the negative step started off with $20 million and within 2 weeks went to $720 million. Okay, so I would be very interested to understand the logic there. I mean, would it basically also imply that the lending fees have gone from a very modest number to some extremely large numbers? Because, again, the Palm three-column example is a nice example because the negative stuff pretty much has been decreasing over the duration of the time. There were some bumps, of course, but some of the negative stuff actually have gone from moderate to extreme large. The second question that I have is, it's not really clear to me whether the high lending fees explain this disparity in spot prices, or because of disparity in stock prices, lending fees adjust effectively to fill the gap. Okay, and I think this has very different implications for what we would like to see the well-functioning market. So is it because we observe that the prices are so different and the brokers adjust the fees, basically to create no arbitrage opportunities for those people? And the third question, this is the question to regulators. I mean, and this is, I'm trying to kind of put a difference in the rates now. There's a lot of IPOs where the number of shares which are offered to public is extremely small. An example that I have is Groupon. It put 7% of shares public, which basically created, again, a very similar situations like we had in three-common palm. Then the number of shares available for lending was very small, and negative short rebate was 100%. So do we want to create this type of situations where the lending fees are such a big part of the pricing process? Or do we basically need to stop this type of practice and say, look, we're not going to have an IPO unless you're going to put 15% or 20% shares for the public float? Because obviously, this very small, float in IPOs create, overpriced shares, and basically give the opportunities for insiders then basically to profit from overpriced shares. So do we want to have this artificially create short selling constraints and high lending fees because of a small float?
So on the middle of your points, I do have a sort of a brief reply. So the reason I pointed to the commodity intuition and the issue of storage was to emphasize that it's not simply is it one side or the other side that adjusts, but I would say potentially both sides, and that we should think of the equilibrium. So I guess I probably wouldn't quite accept the dichotomy that you raised, but I also agree with the spirit of what you're saying, that these markets they're all interconnected, and it's not simply sort of the one side but it's not simply the one side versus the other side.
I have a comment on that, Chester. I was the specialist in options on the CBO, and I think looking at, I know you lean on a lot on the data from the previous paper from Lamont, but I think if you look at transactions as opposed to the bid offer, because I know the bid offers were indications, but they weren't actually where the combinations were trading, and they were trading pretty heavily at the time. So what I saw was, I do believe there was a loan market that determined what price the institutional traders would come to the floor, and they would lay off some of their risk to the option market makers. And I think if you look at the actual transaction prices, you can back into a more precise valuation. as opposed to using the midpoint. Also, there were flex options that traded on SIBO, and I think they'll give you great insight into, again, a more precise valuation for the stub. And I think the last point is just from experience, I believe some of the larger market participants in the options were valuing the put-call combinations more on their risk of buy-in and then hedge post-buy-in. So they would basically have a delta neutral portfolio where they would be short the stock. They had no access to the lending markets. They couldn't go out and pay 30, 40, or 50%. There was no lending market for a lot of participants. It's a very opaque market, which was discussed. And they would get bought in and then immediately, either through options or they would reestablish a short position. And that risk between their buy-in timing and their ability to reestablish their delta neutral position, they would try to quantify that versus the pricing on the put calls. So it was very sophisticated upstairs institutional traders. Some of the market participants were based their pricing less on the lending rate and more on their perceived risk of buy-in. And I think looking at the transactions might help get some more precise values.
Kevin?
Yeah, so that I like this paper because one paper I really like is the Duffy, Arlen, Pedersen paper where they look at the shadow price of security lending on asset pricing. And so I was wondering if you could, shed more light on, how relevant that model might be for what you're showing, and whether or not it can be generalizable in any way using the data you have if you don't actually have lending fees. So I don't know if that's possible to do at all, but I do think that if it's true that lending fees can have such an impact on volatility and pricing, then asset pricing, I think, should take this more into consideration when they model.
Other questions or comments? Okay, let's take a break for 15 minutes then.